So, welcome students, welcome to lecture number 25, where we'll be seeing module 4, income from capital gains under subject direct taxation. So, under this module, as we know, as per VTU syllabus, we have basis of charge, transfer of capital asset, inclusions and exclusions from capital asset, what is capital gain. So, all these first four things we have already covered in lecture number 24. So we are remaining with computation of capital gains, deductions from capital gains, and income from other sources theory only, and problems on capital gains. So today we will be dealing with only computation of capital gain. How are we supposed to practically compute the capital gain arising to a particular SSE on which tax is to be levied? So as we all know that capital gain is nothing but a gain arising from the transfer of a capital asset. And gain is nothing but there are two types of gain, short-term capital gain, long-term capital gain. Gain arising from the transfer of short-term capital asset becomes your short-term capital gain, and gain arising from the transfer of long-term capital asset becomes your long-term capital gain. Now, you'll know the meaning of what is a short-term capital asset and what is a long-term capital asset. See, in general, if an asset is held, if any capital asset, now you'll also know what is the definition or meaning of a capital asset we have seen in a previous lecture. So if any capital asset is held by the SSE for not more than 36 months before the date of his transfer, immediately before the date of transfer, that is the date of sale, it becomes a short-term capital asset, other than those assets that are covered under the holding period of 12 months and 24 months. So in general, it is 36 months, but for certain specified assets, it will be 24 months and 12 months. And if an asset is held by an SSE for more than 36 months, immediately before the date of transfer, it becomes a long-term capital asset. And when he's selling that asset and if he's getting any gain, if it is a long-term capital asset, it is called long-term capital gain. Short-term capital asset, it is called short-term capital gain. Now in different heads of income, like income from salary, income from house property, income from business or profession, we saw there is a specified format by which we can compute what is the income that is to be taxable under that particular head of income. So similarly, in capital gains also, we have a format. So computation of capital gains. And in this computation, we will be seeing short-term capital gain. That is how to compute a short-term capital gain. This particular format, you're going to use only and only if the transfer of an asset that is happening is a short-term capital asset. Okay, then only you are going to use this format for computing the short-term capital gains. Okay, so before we look into the format, can anyone tell how can a gain arise? I mean to ask that, suppose if you have purchased an asset, you are selling the asset, how do you compute at the gain? How do you compute whether you have made a profit or you have made a loss, whether you have made a gain or whether you have made a loss? How do you compute, students? Logically or generally, how do you compute?
Ma'am, if the expenses are more than income, if it is loss for the business, and if the income is more, then it is profit.
Okay, this is from business angle. Now I'm saying if an asset, you have purchased an asset, suppose you have purchased a jewelry, okay, and you're selling that jewelry. Now, whether you have made a profit on that jewelry or a loss on a jewelry, how will you compute? How will you come to know? Okay, let me.
Price is more, then it will be profit, ma'am. Other than purchasing price.
So what will you do is you will take your sales value minus your purchase value. You will get your gain, correct? Like suppose if the jewelry is you have purchased for 50,000, you are selling it for 65,000. So have you made a profit or loss? How did you compute? Whatever is the sales value 65,000 minus 50,000. So 15,000 is your gain. So in simple logic also, without going to the format also, how do you compute your gain from any sale of an asset? Whatever is a sales value, you deduct the purchase cost of that asset, you get the gain. Okay, students? So now we look into the format. So first, always we start the format with sales consideration, full value of consideration. It means that the value at which you are selling the asset and receiving the amount in money or money's worth. So sales consideration is nothing but the sale value of a particular asset. At what price are you selling it? So that is the value that you have to write here. Less expenses on transfer. So while you are selling the asset, you may incur various expenses like brokerage, commission. Suppose if you are selling a house property, to sell that property, you may need to hire a broker. So you need to pay the broker some brokerage charges, correct? So that are the expenses that are relating to your sale. So from the sales value, what you're getting from the customer, you have to deduct the expenses that you have incurred on the sale, on the transfer. You get net sale consideration. So this is your net sales amount that you're going to receive in hand. Now from this net sale consideration, you are going to deduct cost of acquisition. When I say cost of acquisition, it means your cost of purchase. Okay, the the amount at which the amount at which you have purchased your capital asset, it is called as cost of acquisition. Suppose if you have done some improvement cost, and then you have to also deduct cost of improvement. Now what is cost of improvement? If you have done some alteration in that asset, suppose I have taken a house property, okay, I have acquired it for suppose 15 lakh rupees, and I have built one more floor. I have only a ground floor and I have improved it. I have created one more floor to it. So cost of improvement is nothing but all the cost incurred to increase the quality of the asset, to increase the value of the asset. I have renovated the house, it is called cost of improvement. Okay, I have done reconstruction of one more floor, it is called cost of improvement. So whatever cost I'm incurring in improving the asset also has to be deducted. So from the sales value, from the net sales value, when you deduct cost of purchase and cost of improvement, you get short-term capital gain. But government says that we will give you certain deductions under capital gain. We have seen under different heads of income, the provisions of Income Tax Act has provided us with deductions. Similarly, in capital gains also, we have certain deductions. This deduction separately we will be seeing in lectures to come, because this is a complete separate part. So we will now only deal up to short-term capital gain. And then when we deduct exemptions or deductions, which are there under section 54B, 54D, 54G, what are all these sections? What are the deductions available? I will let you all know in the succeeding lectures. When you deduct, you get taxable short-term capital gain. And this taxable short-term capital gain will be liable to tax. So once more, I just revise this particular format. You take the sales value of consideration. That is, what is the meaning of sale consideration? It is nothing but the price at which you're selling the particular asset and you're receiving the amount in terms of money or money's worth from your particular customer. Less expenses on transfer. Expenses on transfer means only those expenses that have to be incurred in order that the sale takes place, like brokerage, commission. Then you get net sales consideration. This is a net value that you will be having. From that, you have to deduct cost of purchase and cost of improvement. Then you get short-term capital gains. Government has given certain deductions. When you deduct those exemptions, you will get taxable short-term capital gains. So I hope everyone has understood this particular format. Yes, students, you'll need not by heart, you'll just understand it. It will be easy for you all. Did everyone understand this particular format? Yes, students?
Yes, ma'am.
Okay. Now, let us understand the meaning of the terms used in computation. I've already explained, but just let us go through it once. So first term that we have used is sale consideration, correct? So what is sale consideration? It refers to the sale value of the asset in the form of money or money's worth. This I've already explained to you all. Next, expenses on transfer. What do you mean by expenses on transfer? It means any expenditure incurred wholly or exclusively in connection with such transfer. When I say wholly or exclusively means that expenses should be only and only related to your transfer. What is transfer? You all already know, students. Such as the expenses such as brokerage, commission incurred for securing a buyer. In order to get a buyer, if you're paying brokerage or commission, or cost of stamp, registration fee by the vendor, traveling expenses, it is reduced from the sale consideration in order to get net sale consideration. So all the expenses relating to your sales you have to deduct from the sale consideration in order to get net sale consideration. Next, cost of acquisition. What is cost of acquisition? Cost of acquisition includes expenditure incurred for acquiring the asset or completing the title of the asset. So whatever cost is incurred in order to purchase the asset, it is said to be the cost of acquisition. Next, cost of improvement. Cost of improvement means any expenditure incurred to increase the productive quality of the asset. It includes all the expenditures of a capital nature incurred in making any additions or alterations to the capital asset. Either you alter the capital asset, whatever expenses you're incurring, in order to improve the quality of that asset, value of the asset, it is said to be cost of improvement. So now we have learned how to compute a short-term capital gain. Now let us understand how to compute a long-term capital gain. So can anyone tell me what is a long-term capital gain? What is the meaning of long-term capital gain? Students, can you quickly tell me what is the meaning of long-term capital gain? Students, am I audible to you all? What is a long-term capital gain? Students, am I audible? Students? Can you all hear me?
Madam, investing in a
Yeah, ma'am.
particular company
Uh,
Investing in a particular company.
and gaining dividend for a long term period of time. I mean, investing in a
Ma'am,
particular company shares.
Ma'am, gain arising from the
ma'am,
transfer of long-term assets, long-term capital assets.
Correct. So, whatever
holding an asset for more than 1 year and selling it after,
36 months, more than
and gaining
36
the
months or 12 months in certain,
sorry, 36.
12 months
Yeah.
or 24 months, and then you're selling the asset, transferring the asset, it becomes a long-term capital asset, and whatever gain you're arising from the transfer of long-term capital asset, it becomes your long-term capital gain. Okay. So how to compute that gain? Simple. Your sales value minus your purchase value. That is in simple terms. But the format remains the same as in case of computation of short-term capital gain. But instead of using cost of acquisition, we will use indexed cost of acquisition. And instead of using cost of improvement, we will use indexed cost of improvement. Now, what is the meaning of these two? Let us understand. First, as I told you, the format remains the same as we compute the short-term capital gain, like sales consideration, that is full value of consideration, less expenses on transfer, you get net sale consideration. From that, you have to deduct index cost of acquisition, index cost of improvement, you get long-term capital gain. Again, the entire long-term capital gain is not chargeable to tax. You have certain exemptions given under the Act. So you deduct these exemptions, you will get taxable long-term capital gain. This is a separate thing that we are going to deal in the succeeding lectures. Now, quickly, what is sales consideration? It is the same explanation that I have given for the short-term capital gain. That is nothing but the sales value. Next, expenses on transfer is all those expenses incurred wholly and exclusively for the transfer, for the sale that you're making, whatever expenses you're incurring. Okay, you get net sales consideration. Next, indexed cost of acquisition. Students, now cost of acquisition, as you all know, is nothing but the cost of purchase, correct? Now, since it is a long-term capital asset, means you have held that asset for more than 36 months. So why you have to index that cost of acquisition is you have to bring that asset's value as on the present value by using the cost inflation index. For example, if I tell you all, in 2000, if an asset was purchased, suppose for 50,000, and now the asset's value has become, suppose it has become 10 lakh rupees. So the gain will be too very high. That is 10 lakh minus 50,000. It will be 9 lakh 50,000 gain. So what government says that, what provision says that, if it is a long-term capital asset, you use not the actual cost of acquisition, but bring that cost of acquisition to the present value, to the today's value, by using the cost inflation index, because every year there will be an inflation happening. So convert this cost of acquisition into the cost, convert the cost of acquisition into indexed cost of acquisition by using cost inflation index, since the asset is hold for more than 36 months. Similarly, cost of improvement. Now, what is cost inflation index? I'll let you all know. Similarly, cost of improvement. Cost of improvement is nothing but, again, whatever cost you're incurring in order to improve the asset, you have to convert the actual cost into the indexed cost. How are you going to make the conversion? By using cost inflation index. Now, cost inflation index is nothing but the indexes that are decided by the central government based on the inflation rate or based on the consumer pricing, change in the pricing happening every year, and the central government notifies that in the official gazette. So for every financial year, there is a cost inflation index given by the government, notified by the central government. So we have to use that inflation index and convert our actual cost of acquisition into indexed cost of acquisition. Otherwise, people will land up paying heavy long-term capital gain, since the period of holding is too very huge. It is more than 36 months. Some people can even hold an asset for more than 25 years. So the value of money then and now at present, there is a lot of difference, time value of money. So in order to convert that monetary value into its present value, we use cost inflation index. So students, have you all understood this particular format? The computation of long-term capital gain remains same as short-term capital gain. Only difference is, for long-term capital gain, you have to use indexation. Indexation means index cost of acquisition and index cost of improvement. So everyone, have you all understood this particular format? We'll move ahead by understanding these terms.
Yes, ma'am.
Okay. Okay. Meaning of terms used in the computation in the earlier slide. We know what is sales consideration. It is same like what we have seen in the short-term capital gain. We have seen expenses on transfer, which is same as that we have seen in the short-term capital gain. Now, what is indexed cost of acquisition? Like I told you, it means the cost of acquisition as discussed in the case of short-term capital gain, that is cost of purchase, adjusted according to the price level of the year of sale. Means you are going to adjust the cost of purchase depending on the price level in of which year, of the year that you're making the transfer or of the year that you're making the sale. So how are you going to compute the cost of acquisition? So index cost of acquisition will be whatever is the cost of acquisition, actual cost of acquisition, divided by index. You have indexes that will be provided for you all in the exam also. You need not by heart the indexes. Cost inflation index will be given for the year of acquisition and for the year of transfer. So you have to use the cost inflation index of the year of acquisition into the cost inflation index of the year of transfer. If you use this particular formula, you will get indexed cost of acquisition. So always remember, index you have to use for 2 years. Year that you're acquiring the asset and index of the year that you're in the year that you're going to sell the asset or transfer the asset. Now, what is index cost of improvement? It means the cost of improvement, as we have already discussed in short-term capital gain, adjusted according to the price level of the year of sale. So how to compute index cost of improvement? It is nothing but cost of improvement divided by index of the year of improvement into index of the year of transfer. Whatever is the index decided by central government, students, it is universal. We cannot change the index. It will be provided. The chart will be provided in your examination. As for FM, you will be provided with those charts, tables. Similarly, index tables will be provided. And if not provided, it will be mentioned in the question itself. So has everyone understood what is index cost of acquisition, what is index cost of improvement, and how do we compute it? Yes, students?
Yes, ma'am.
Okay. So let us understand what is cost inflation index. I've already explained, but just we will go through it. Cost inflation index, it is called CII in short. In relation to a previous year means such index as the central government may, having regard to 75% of the average rise in the consumer price index urban for the immediately preceding previous year to such previous year by notification in the official gazette specifying this behalf. Means it is specified by the central government depending upon the rise in the price of a previous year compared to the next previous year. Like suppose this financial year to next financial year, there will be obviously some rise in the prices. Okay, so that is decided by the central government and it is published by notified by the central government to the public. So this is cost inflation index. So I'll just, this is a cost inflation index from 2001, 2002 to 2019-20 financial year, which we are going through. So this is all the cost inflation index that is specified by the central government in the official gazette. And this chart will be provided either in your final examination or for a particular year, what is the CII for the year of acquisition and CII for the year of transfer will be specified. So this is just a chart for you all, just to show you all that how the cost inflation index for each year is defined. So when I say the transfer has taken place in the year 17-18, so CII for the year of transfer, you have to check for the financial year 17-18, it is 272. When I say that the asset is purchased in 2004 and 5, so you have to see financial year 4 and 5 and take CII for the year 4 and 5, that is 113. So this is how you have to pick. And remember students, this chart has to be used only if it is a long-term capital asset. If it is a short-term capital asset, indexation benefit will not be given. Only for a long-term capital asset, indexation benefit will be given. So this is very important. Next. Now we have seen here students that the CII is starting from which year? 2001, 2002. What if an asset is purchased before 2001, 2002? So always remember, you have to always begin the CII from the year 2001, 2002 only. So let us see what is going to be the treatment of assets acquired before 1st April 2001. Why? Because our CII is starting from 2001, 2002, where the base index is 100. Okay. So what if the assets are purchased before 2001 and 2? That is before 1st April 2001. So what is going to be the cost of acquisition? This is very, very important. Pay attention. If an asset is acquired before 1st April 2001, then the cost of acquisition shall be the higher of the following. So it will be actual cost of acquisition or fair market value of the asset as on 1/4/2001. So suppose if any asset is purchased before 1st April 2001, then you have to take the cost of acquisition as whatever is the actual cost of acquisition or market value as on the date as on 1/4/2001. Whichever is high, you're going to consider it as a cost of acquisition. But this option is not available to asset on which depreciation is allowed under section 32. We have seen all those assets under which depreciation is allowed under section 32 under PGBP, and self-generated assets other than bonus shares. Now, what is self-generated assets? Goodwill. Goodwill is an asset which is, goodwill can be two types. Either you can purchase the goodwill or you can self-generate the goodwill. So in those cases, this option will not be available. Next, cost of improvement. If any cost of improvement is incurred by the SSE or the previous owner before 1/4/2001, it shall be ignored and it shall not be considered. So remember students, the treatment of assets acquired before 1/4/2001, cost of acquisition will be higher of actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. And cost of improvement, you have to ignore it and you have to not consider cost of improvement. Next, indexation, we have seen that where the asset is acquired before 1/4/2001, indexation benefit will be available to that asset, but from which year? From 2001 to 2002. Reason being, indexation is starting from that year. Is this clear, students? Is this particular slide clear?
Yes, ma'am.
Okay. Now, whatever we have seen in today's lecture, we will take a few sums on that so that we understand the theory properly, whatever we have dealt with. Okay, so let us see problems on short-term capital gains and long-term capital gains just to understand the theory. Okay, is the screen visible to everyone?
Yes, ma'am.
Okay, now Mr. Divesh had purchased a golden ring as on 17 August 2018 for 20,000. On 1st May 2019, he has given a diamond on it costing 25,000. On 1/8/2019, he sold the ring for 80,000 and incurred brokerage for arranging a customer 5,000. Compute capital gain. Based on today's explanation, students, I'll just explain this problem. He had purchased, then this becomes a cost of acquisition, that is 20,000. Does everyone agree with me? Later we will see whether it is a short-term capital asset or long-term capital asset. But let us first identify the terms that are used in the format. So Mr. Devesh had purchased a golden ring, so it becomes cost of acquisition. Does everyone agree with this?
Yes, ma'am.
Okay. Next, on 1/5/2019, he has even a diamond on it. See, I've taken a golden ring, and later to improve its quality or to improve it, I have even a diamond ring, diamond on it. So will the value of the asset increase, students?
Yes, ma'am.
So it is an improvement to the asset. Correct.
Yes, ma'am.
So this 25,000 becomes what? Cost of improvement. Does everyone agree?
Yes, ma'am.
Okay. Next, on August 2019, he sold such ring for 80,000. So does this become the sale value or sale consideration?
Yes, ma'am.
Okay.
ma'am.
And incurred brokerage for arranging the customer. In order to make the sale of 80,000, he had to give some brokerage charges in order to get the customer. So this is expenses on transfer.
Yes, ma'am.
Okay. So students, only four terms you'll need to identify in any problem. What is the sales consideration? What is the expenses on transfer? What is the cost of acquisition? What is the cost of improvement? Now, once you have understood what are the different terms, second, how will you identify whether it is a short-term capital asset or a long-term capital asset? Simple. From the date of purchase up to the date of sale. Date of purchase is 17th August 2018 and date of sale is 1st August 2019. So from the date of purchase to the date of sale, you have to see the period of holding. Period of holding by Mr. Devesh. For what period is he holding the golden ring? So is he holding the golden ring for more than 36 months or less than 36 months, students? The date of purchase.
Less than 36.
Less than 36 years.
Less
So,
than.
so it is a short-term capital asset or long-term capital asset?
Short
Ma'am,
term.
short.
So when Mr. Divesh is selling a short-term capital asset, what is the gain that he will get, short-term or long-term?
Short-term
Short
gain,
term.
ma'am.
So which format are we going to use? Format for computation of short-term capital gain. So we start the solution by computation of capital gain of Mr. Divesh for the assessment year 2020-2021. So this is the format. You all know sales consideration, which we have identified as 80,000, less expenses on transfer, which is nothing but the brokerage charges that has been paid, that is 5,000. Then once you minus this both, you get the net sale consideration, that is 75,000. From that, you will deduct the cost of acquisition, which is 20,000. That is the cost of purchase. Next, you will deduct cost of improvement, which is nothing but any cost incurred to improve the quality of the asset, to improve the value of the asset. So 25,000 is the cost of improvement. So total is how much? 45,000. So from 75,000, you are going to deduct 45,000. You will get 30,000. So this is the short-term capital gains. Now we have not seen the deduction part. When we see deduction part, we will take the answer further, that is less deductions, you will get taxable short-term capital gain. For now, whatever we have seen in today's lecture, we are covering sums only relating to the lecture covered today. Now students, tell me why indexation is not used for this particular sum? Why?
Short-term asset, ma'am.
Very good. Indexation is only used for long-term capital gain. Okay. Now, let us see the problem number 2. On 23rd December 2019, Rajat sold 500 grams of gold, the sale consideration of which was 13 lakh 50,000. So what is the 13 lakh 50,000? Which term is this, students? Now term means you'll have to remember there are four terms: cost of acquisition, cost of improvement, expenses on transfer, or sale consideration. So tell me, 13 lakh 50,000 is what?
Sale value of asset.
Very good. Now, next, he had acquired this gold on 20th August 2000 for 4 lakh. Now, what is 4 lakh?
And cost of acquisition.
Very good. Fair market value of 500 grams of gold on 1st April 2001 was 3 lakh 60. So, this is fair market value. Now, next, find out the capital gain chargeable to tax for the assessment year. Sorry, students, it is 2020-2021. Okay. Now, students, tell me, he has sold the asset in 2019. Okay. And he had acquired it in 20th August 2000. Okay, students?
Yes, ma'am.
Okay. So is this the treatment? Should we give the treatment for this as assets acquired before 1/4/2001? Should that treatment be given? Yes. Why? Because the asset is acquired before 1/4/2001. Asset is acquired on 20th August 2000. So let us start the solution. Computation of capital gain of Mr. Devesh for assessment year 2020-2021. Now students, 2019 he's selling, he had acquired in the year 2000. Is it a short-term capital gain or long-term capital gain? Is he holding gold for more than 36 months or less than 36 months?
Ma'am, long term.
Yes. So first we take sales consideration, 13 lakh 50,000. Less expenses on transfer. Students, there are no expenses on transfer given in the question. Therefore, we have taken it as nil. Next, we get net sale consideration, 13 lakh 50,000. From that, we deduct indexed cost of acquisition. Now, why we are using indexed cost of acquisition? Because indexation is given to all the long-term capital assets. Okay. So index cost of acquisition. What is the cost of acquisition you will consider if the asset is purchased before 1/4/2001? So look at the note. If an asset is acquired before 1/4/2001, then cost of acquisition will be higher of the following: actual cost of acquisition or fair market value of asset as on 1/4/2001. Now what is the actual cost of acquisition? 4 lakh rupees. See, 4 lakh is the actual cost of acquisition, or 3 lakh 60,000. Which is higher in this two?
Ma'am, 4 lakh.
So 4 lakh will be your cost of acquisition. This is cost of acquisition. But remember, for long-term capital gains calculation, we have to index it. So how do we index it? By using CII, cost inflation index. What is the formula for index cost of acquisition, students? Cost of acquisition, correct, divided by the index of the year of acquisition into the index of the year of transfer. Now, since the year of acquisition is before 1/4/2001, therefore we are taking 100 as the index. Students, what I have told you all, since the asset is purchased before, indexation will always start with 100, that is 2001, 2002. So what we have done is 4 lakh divided by 100 into index of which year? Index of the year in which the asset is being sold. Asset is sold in 2019. So it becomes which financial year? 1920. So what is the index of the financial year 1920? It is 289. So what we have to do? 4 lakh divided by 100 into 289. So you get 11 lakh 56,000. So this 4 lakh, you have indexed it and brought it as on the value of today. So once you minus this both, you get a long-term capital gain of 1 lakh 94,000. Students, have you all understood what is indexation, benefit of indexation? If you would have not done indexation, you would have taken here as 4 lakh. And 13 lakh 50,000 minus 4 lakh means it becomes 9 lakh 50,000. So you had to pay tax on 9 lakh 50,000. So government is giving you the benefit of indexation in order to bring it to the price level, adjusted to the price level as on the date of transfer. So have you all understood this particular sum, students?
Yes, ma'am.
This sum was on a treatment where the asset is acquired before 1/4/2001. Did everyone understand this particular sum? Okay. Moving ahead to problem number 3. Mr. Anand had purchased a house property as on 17/8/2002 for 5 lakh. So tell me, students, what is this to 5 lakh rupees? Which term it is?
Acquisition cost.
Acquisition cost.
Very good. Okay. On 1/5/2004, he constructed a new floor on the same house costing 2,50,000. So what is 2,50,000?
Improvement cost.
Cost of improvement.
Very good.
Improvement cost of improvement.
Very good. On 1st October 2019, he sold such house for 18 lakh. So what is 18 lakh?
Sale consideration.
And incurred brokerage for arranging the customer at 2% of 18 lakh at 2%. So what is this brokerage?
Expenses.
On transfer. Now, after identifying the terms, you need to identify whether it is a short-term or long-term capital asset. How do you identify? You see the date of purchase up to the date of sale. If from the date of purchase to the date of sale, if it is, now since it is a house property, means the period of holding will be 24 months. Is it more than 24 months, less than 24 months? From 2002 to 2019, is the period of holding more than 24 months or less than 24 months? Students?
More than 24.
So it becomes a long-term capital asset, correct? So we have to use the format for computation of long-term capital gain. So look into the solution. Computation of capital gain of Mr. Anand for the assessment year 2020-2021. What is the format? As we know, for sales consideration, less expenses on transfer, you get net sale consideration, less indexed cost of acquisition, less indexed cost of improvement, you get long-term capital gain. So quickly we'll substitute the figures in each of the terms. Sale consideration, as you all told me, it is 18 lakh. So we've written 18 lakh. Less expenses on transfer, it is 2% on the sales value. So 2% of 18 lakh, which is 36,000. You get net sales consideration as, after minusing the both, you get as 17 lakh 64,000. From that, you deduct indexed cost of acquisition. Now, what is the formula for indexed cost of acquisition? The cost of acquisition divided by the indexed cost inflation index as on the year of acquisition. So 2002, what is the cost inflation index? 2002, 2003, what is the cost inflation index? 105. So we have written here 105, and numerator will be cost or the CII for the year of transfer. Now, which year it is being transferred? He sold on 2019. So what is the CII for 2019? The index for 2019-20 is 289. So 289 will be your numerator and 105 will be your denominator. Once you solve this, you will get 13,76,190. So remember, always your numerator will be the index of the year of transfer and the denominator will be the index of the year of acquisition. Next, index cost of improvement is nothing but the actual cost of improvement, which is nothing but 2,50,000 into numerator is going to be the indexed of the year of transfer. So it is getting transferred in the financial year 1920 and the index is 289. We have written here 289 divided by the year index of the year in which the improvement took place. Improvement took place in the which financial year? 2004. So 2004-5 the improvement took place, which is 113. So 113 we are writing as a denominator. So once we solve this particular thing, we get it as 6,39,381. So we add this both, take it in the outer column, it becomes 20,15,571. So what is the long-term capital gain? It is a loss because your cost of acquisition and improvement is more than the net sale consideration. So this becomes a long-term capital loss. If you're not writing your loss and gain, just write it in a bracket. 2,51,571. So it is understood when you're writing it in a bracket that it is a loss. So did everyone understand problem number 3? Yes, students?
Yes, ma'am.
Okay, so all these sums what we did today was based on the lecture that we have covered today, theory part that we have covered today. So your important part that we have seen is in case of short-term capital gains, there is no indexation. In case of long-term capital gain, indexation is given. How do you compute the indexation? We have seen the formula. You take actual cost of acquisition into CII of the year of transfer divided by the index of the year of acquisition. And for improvement, actual cost of improvement into CII of the year of transfer divided by the CII for the year of improvement. So thank you, students. We have completed with the lecture.